Hi, welcome. I'm Zara Altair, and as a financial advocate, I am dedicated to helping women go from financial dependence to financial independence. So let's start our presentation on women and wealth. So welcome and thank you for being here today. We're going to discuss some of the challenges women face as they plan for retirement and transition into retirement. Now, granted, there are some universal challenges that nearly everyone faces as they prepare for retirement, but for reasons we'll discuss in a bit, women often face a unique series of risks and hurdles that they must overcome in order to live the retirement they've always managed. Let's get one thing out of the way right up front, right now. Contrary to what the general financial industry would have you believe, women are not a unique niche market. They are the market. And it's time we stop treating women's financial challenges as one-offs. Before we dive in, I'd like to share a little bit about myself. I've been licensed in the financial world for over 30 years, and I work now as an independent agent with Blue Sky Financial, which is a values-based organization, and every decision I help clients make is based on values. And um, I offer individual, family, and business solutions with over 100 A-rated carriers. So we have a lot to choose from for quality solutions for your financial life. Let's talk about what we're going to cover today. We're going to talk about economic challenges, and we'll talk about women's retirement planning challenges and retirement planning, some basic retirement planning strategies for women and how to get started. Also, I want to briefly touch on our objective. Everyone in this presentation may be coming from different starting points. We may have some women in the audience who are very savvy and are looking to fine-tune their strategy, and also others who are just starting out and are building their foundation of financial knowledge. Wherever you are at this point in time, that's fine. We're all here for the same reason, to learn. No matter where you're starting from, there's always room and opportunity for improvement, and that's why we're here together today. Before we talk about retirement planning strategies, let's talk about how far women have come from a financial standpoint. In 1848, the state of New York passed the Married Women's Property Act, which accomplished a few things for women. It made it so that women were no longer liable for their husbands' debts. Plus, she now had the ability to sign her own contracts, receive rent or inheritances without her husband's involvement, and even file a lawsuit. In short, it established a basic level of financial independence for women. And by 1900, every other state had passed a similar law. But what's really hard to believe is that women couldn't even open their own bank accounts at most financial institutions until the 1960s. That's right. As recently as 60 years ago, a woman could not open her own bank account. In 1974, Congress passed the Equal Credit Opportunity Act, which meant lenders couldn't discount a woman for a loan or credit simply based on her gender. More women say they are the primary responsibility for managing finances and making financial decisions for their household. Now, this is really great because 30 years ago, when I first started out, I met women who had never had any financial responsibilities. Their husbands took care of everything. They didn't know how to write a check. So we've come a long way and we're going to go farther. We're going to go farther. So nearly half of all women, 49%, consider themselves to be the chief financial officer for their household. And that is up from 41% in 2021. And that's just 2 years, all right? So for married women, this increased from 34% in 2021 to 43% in 2023. And Gen X women, 54%, are the most likely to consider themselves that CFO compared to millennials at 51% and boomers at 41%. Wherever you are at this point in time is fine. We're all here for the same reason, to learn. No matter where you're starting from, there's always room and opportunity for improvement. But even with all that progress, we still have more progress to make. As we're about to discuss, there are some fairly significant challenges, especially retirement income planning, that are unique to women. In the rest of this presentation, we'll discuss those challenges as well as some strategies to overcome them. Taxes have a big impact on your ability to save for retirement, so it's important to understand your specific tax liabilities and take steps to minimize them whenever possible. The top income tax rate right now is 37%. And as always, I want to stress that you want to consult with your tax advisor for details about your personal situation. So let's talk a little bit about capital gains. That the amount you pay in capital gains can have a significant impact on your tax liabilities when you sell an investment, whether it's a mutual fund or a home. Investment gains resulting from an asset sale are categorized as either short-term or long-term gains. Short-term gains apply to assets that are held for less than a year and are taxed as ordinary income, just like any other income you might have. Um, and they're based on your tax bracket. And remember, the highest tax bracket is 37%. Long-term gains apply to assets sold after being held for more than a year, and these gains are taxed at a lower capital gains rate. So let's take a look at that. When planning for retirement, it's important to know that capital gains tax rates are often much lower than ordinary income tax rate. For example, a single person making between $47,026 and $518,900 per year would pay a 15% long-term capital gains rate. So that's often much, much lower than the highest tax bracket of 37%. Similarly, a married couple filing jointly that earns between $94,051 and $583,750 per year would pay only 15% on long-term capital gains. So that's significantly less than the same taxpayers would owe on ordinary earned income. As you're saving and investing for retirement, it's important to actively manage your tax liabilities. So don't be afraid to ask your tax advisor questions about your tax liability. So be aware of holding durations. Whenever possible, try to hold assets for at least a year before selling. This subjects them to sale to capital gains rate rather than that ordinary income tax rate. And then if you have a loss, you can use those losses to offset gains whenever it makes sense to do so. Be sure to work with that qualified advisor to properly execute this strategy. And you can take advantage of low income years, like when you have a period of unemployment or once you retire, to sell appreciated assets at lower capital gains rates. Even though women's challenges are common, they're often overlooked and underplanned for. And that's what we want you to be aware of today. So let's look at some common retirement planning challenges that can make it more difficult for women to save for retirement. There's the retirement savings gap. The median 401k account balance for women is 65% lower than men's. And in 2023, women's average salaries were 83.6% of men's, and of women ages 55 to 66, 55% have no personal retirement savings compared to 47% of men. So the next question is why? Women are more likely to work in part-time positions that don't offer access to retirement plans. Women are more likely to take time out of the workforce to care for others, such as children and aging parents, which leads to a break in earning and in saving for retirement. And also, women tend to make less than men, just 85 cents for every dollar that men make. Let's talk also about longevity. That's how long you will live. The average 65-year-old man has a 50% chance of living to age 87 and a 25% chance of living to age 93. But the average 65-year-old woman has a 50% chance of living to 89 and a 25% chance of living to age 95. Married couples have a 50% chance that one spouse will live to at least 93 and a 25% chance that one spouse will live to age 97. So as you can see, there's a long period of time after age 65, which is considered the general retirement age, where you need to cover all of your living expenses. On average, a woman who turns 65 in 2022 can expect to live to age 85.1, while a 65-year-old man can expect to live to 82 and a half. That means women can expect to live nearly 3 years longer in retirement. And if long-term care is necessary, that also means that women can expect to pay for an additional 3 years of care, which is a significant retirement expense. So 21% of men live alone, and 27% of women live alone at ages 65. And I include this information to show that women are more likely than men to be solely responsible for providing for themselves throughout their retirement years. So 43% of women live alone after age 65. One of the things you need to consider in retirement planning is healthcare costs. Women's longer life expectations also lead to high healthcare costs and increased need for long-term care. A 65-year-old single woman can expect to spend approximately $165,000 in out-of-pocket healthcare expenses compared to $150,000 for a 65-year-old single man. Women are also more likely to live in a nursing home as they comprise 63.3% of all nursing home residents. The bottom line is women must plan intentionally to achieve a reliable retirement, and that's why we're here today. Up to this point, we've talked about the challenges you may face in retirement and how those challenges could impact your ability to support your lifestyle. Now let's turn to developing a plan to overcome those challenges on what steps we can take to manage these risks and help ensure that we live the kind of retirement we've always imagined. And that's what we'll discuss over the next few slides and through the rest of this presentation. Let's talk next about why a financial strategy is important and why women need a financial strategy. So I encourage you to think seriously and consider what you have on hand right now and be aware of what the expenses may be when you are retired. Each stage of life brings events that can reshape your financial life and your concerns, and they impact the ability to plan for and achieve long-term financial goals. Having a strategy in place now can help you better manage future life events, especially since many women arrive at financial decisions from a more emotional, value-driven perspective versus an economic one. So let's look at each of these life events as we go through them. I want you to note the ones that are relevant to you right now. Changing jobs, getting a raise, and these are career planning events. And when these things happen, you can use additional disposable income wisely, which includes putting money aside for retirement. And on the other side, we have losing your job and you need a safety net to pay the bills. Family can be a positive or negative change in terms of money. Changes in your family status mean changes in your financial needs and how you define financial security. So you can getting married, having your first child, sending children to college, caring for an elderly parent. These are all examples of family situations that can arise. And let's talk for a minute about the sandwich generation, which is caring for aging parents and raising kids still living at home. This situation has become more common as average life expectancy increases and more women have children at older ages. It's two factors that impact the sandwich generation. The sandwich generation can create high levels of stress and negatively impact the ability to plan for long-term financial security. Remember, I talked about how women use emotions to plan. And so even when you are in situations like this, you want to make sure that you are planning. So establishing a financial strategy now can help you prepare for any financial needs you might face with your parents, such as long-term care, which also covers needs for your children, like college planning. And we have life-changing events like your home. So whether you're buying your first home, downsizing, or maybe you want to even age in place and need to remodel your existing home, a financial strategy can help you purchase and protect where you live. And if you have a business, your own company or a side hustle, it is extra important to have a financial strategy because financial security forms the basis of your business success as well. And then there's those times when women need to start over, getting divorced, becoming a widow, or an empty nester. These changes may involve challenges you didn't originally plan for, and your financial situation can change unexpectedly. If you want to maintain your standard of living during retirement, you have to plan carefully. Social Security may not be enough. In fact, in a study by Allianz, they found that 63% of women are more worried about running out of money than they are about death. So making appropriate financial decisions now and having a plan in place can have a huge impact on your retirement. And of course, we can't continue without looking at the latest financial crises of the past couple of years, where inflation reached record levels. So this can impact your ability to plan or achieve long-term goals. You want to consider not just how much your money is worth now, but what the buying power will be in the future. The first step in planning for a successful retirement is to gain an understanding of how much money you will need to cover your family living expenses. An effective way to estimate these expenses is by looking back on what you spent in the past years. Do you expect these costs to be higher or lower once you retire? For example, if you currently have a 45-minute commute to and from work each day, you may be able to lower your transportation costs once you're no longer working. But on the flip side, if your employer-provided health insurance covers the majority of your premiums and copays, you may need to budget more for out-of-pocket health care expenses in retirement. So once you have an idea of your monthly budget, you can better estimate whether your retirement savings are adequate to meet your needs. In other words, you're going to establish your goal of what your expenses are going to be in retirement so you can plan to cover those expenses. Once you've estimated your monthly retirement expenses, it's important to gain an understanding of how much money you have to work with. Retirees typically fund their daily living expenses from three sources: pension payments, obtain an estimate from your employer's Human Resources Department to get an idea of what that's going to be, Social Security, use the Social Security Administration's online benefit estimator to model various Social Security scenarios, and retirement savings. A financial professional can help determine a sustainable withdrawal rate based on your retirement savings. You may have additional sources of income, such as rental properties or business interests, that should also be included in your calculation. Added together, these income sources equal your projected retirement income stream. So you're going to look at what you think your expenses are going to be, and then you're going to look at what your income stream will be in retirement. If you or your spouse has a pension, it's important that you understand all of your payment options and make a careful election on how you will receive benefits. There are typically three options. There's single life. That means payments are made only during the lifetime of the plan participant. That could be you if it's your pension plan. This typically offers a higher monthly payment amount than the joint and survivor option, but it offers no protection to a surviving spouse. Then there's joint and survivor. This option typically offers a reduced monthly payment amount. However, some form of benefit continues for the surviving spouse after the participant dies. And then 3 is period certain. The participant can decide when and for how long to receive payments. This option can provide a higher payment amount. However, you may run the risk of outliving your income if you live longer than that elected period. So at age 65, and for example, you might choose a period certain of 20 years, which would take you to age 85, but then those payments would stop. So you need to think about longevity and how that can impact your retirement income and your pension payments. And also the strength of the company itself, your employer, is important when it comes to pensions. If the firm paying your pension has financial troubles, you may have issues collecting those pension payments for life. That's why we want to talk about financial independence. The monthly benefit amount you receive from Social Security depends in part in how old you are when you begin taking those benefits. If you file after age 62, but before full retirement, your benefit could be reduced by as much as 30%, and this is a permanent reduction. So if you elect to take Social Security benefits early at age 62, they aren't going to jump up later on when you reach that full retirement age. So be careful when you think about that. Um, I know my neighbor's waiting for her to reach full retirement age so she doesn't have that reduced Social Security benefit. At full retirement age, you're eligible for the full benefit amount. And if you delay until after your full retirement age, you can receive a credit of 8% for every year you delay from full retirement to age 70. So, for example, if your full retirement age is 67, but you delay taking benefits until age 70, you would receive a 24% increase in your benefits. So that's 8% per year for 3 years. When considering withdrawals from your retirement savings, it's important to understand the tax treatment of each of your accounts. An advisor can help you establish a tax-efficient withdrawal strategy to minimize your taxes and maximize your monthly income. Withdrawals from tax-deferred vehicles are generally taxed at ordinary income rates and may incur an additional 10% Internal Revenue Service penalty before age 59 and a half. Roth IRA distributions are tax-free after age 59 and a half, and the account has been open for at least 5 years. Municipal bonds are free from federal taxes and possibly state taxes, and life insurance distributions via loans and withdrawals will reduce policy values and death benefits and may cause the policy to lapse or require additional premiums to keep the policy in force. One way to bridge a retirement shortfall is by increasing your savings rate while you're still working. The IRS allows workers age 50 and older to contribute additional funds to their retirement accounts in the form of what are called catch-up contributions. In 2024, plan participants under age 50 can contribute up to $23,500 to a 401k plan. Participants age 50 or older can contribute an additional $7,500 per year for a total potential contribution of $31,000. The maximum contribution for Traditional and Roth IRA is $7,000 with an additional $1,000 catch-up contribution for those age 50 and older. Another strategy to bridge the retirement income gap is to cut back on spending. You may want to consider reducing your monthly spending, downsizing your home, cutting back on discretionary spending, and paying off debt to avoid high interest rates and credit card fees. Consider making a gradual transition to retirement by cutting back on how much you work overtime. This can help you continue earning and saving and possibly allow you to delay your Social Security benefit. Work part-time after you retire, or focus on funding a health savings account to cover medical expenses in retirement, and consider purchasing long-term care insurance policy to help cover the costs of future care. Many of the challenges women in retirement face are due to uncertainty, market fluctuations, variations in retirement income, etc. A fixed income annuity provides a guaranteed lifetime income stream you can't outlive. You know exactly what you'll receive each month. Benefits include growth potential and the downside risk protection and guaranteed lifetime income. Annuities can be effective tools for some. Both fixed and indexed annuities can add to your monthly retirement income. The benefit is that this type of payment is typically guaranteed to last as long as you live. Let's take a look at different types of annuities. Immediate annuities, you contribute a lump sum premium and the insurance company immediately converts the funds into income. Income is typically paid for life regardless of how long you live. There may be options to continue paying to your spouse or another beneficiary after you pass away. On the deferred annuities, the premiums are paid and grow on a tax-deferred basis until you're ready to begin drawing income. Some earn interest while others are invested in indices of the financial markets. A few things to understand about life insurance. First of all, the death benefit can provide supplemental income, and there's possible cash value that may earn dividends and interest, and withdrawals of premiums are tax-free. Most permanent life insurance policies offer a death benefit and a cash value component. And the cash value grows tax-deferred through either dividend or interest payments. And if you ever need money from the policy to cover expenses, you can take tax-efficient income from the policy. One way to access income is by making a tax-free withdrawal of your premiums. You may also be able to take a tax-free loan, essentially borrowing against your own policy. And if you don't repay the loan before you pass away, the balance is deducted from the death benefit. After you die, the remaining death benefit is distributed to your beneficiaries, and funds are tax-free and avoid probate. Life insurance can be a beneficial strategy for those seeking lower risk, tax-free growth, and also want to leave a financial legacy for loved ones. The best way to ensure you have enough assets to last throughout retirement is by developing a custom retirement income plan to meet your personal financial needs. Because women face additional retirement planning challenges, it's especially important to have a plan in place. Consider working with a qualified financial professional who can help you implement a wide range of planning strategies such as tax-efficient withdrawal strategy, health savings contributions, life insurance, annuities, etc. What you need is going to depend on your personal situation. So I invite you to schedule a complimentary consultation. Let's sit down and review your current plan and discuss where you want to go. I call this a retirement gap analysis. And then we create a custom retirement income plan that meets your specific needs. It all starts with a strategy. What's yours? And if you don't have a strategy, I'm happy to help you design one made just for you. Thank you so much for being here today. And if you have any questions, please get in touch and I'm happy to answer any questions. Thank you for being here today.